Good evening and welcome to the Millennium Week final. Tonight we are here not to talk about all the random stuff. We are here to close the loop because knowing what to buy is only a half of fight. The other half is the cost you enter it. Most people spend their whole investing life asking one question: what should I buy? But serious capital asks a sharper question. If I decide to own it, what is starting point can I secure? That is what tonight is about. Decision first, cost second. The cost gap changes everything. Over the past 4 nights, we started with the retail condition. We looked at the traps that pull normal investors into the emotional decisions. We moved into the information circle because the room you are in decides what reaches you, how early it reaches you. Then we studied the institutional sides of the screen. Last night we opened the bonnet on the six-dimensional engine. Tonight, last two pieces land together. First, how institutions decide what is worth owning. The second, what they pay to get in. This is the full picture. Institutions do not decide from one fragment. They read 6 dimensions at once: technicals, fundamentals, sentiment, fund flows macro, and peer flow. Technicals shows where the price structure is moving. Fundamentals show what the business is actually worth. Sentiment shows how the crowd is positioned. Fund flows shows where serious money is moving. Macro shows the liquidity backdrop. Peer flow shows what the other smart players are doing. Not one indicator, not one headline, not one emotional reaction at 9:30 p.m. 6 independent inputs, one decision. That is where retail and institutional thinking separate. Retail acts the moment one signal looks good. A stock breaks out, a hot chat groups get excited. The candle turns green and the brain feels it must move now. But institutions wait until all six align. During quiet accumulation, most people see nothing. The charts may look dead, the room may feel boring, but under the surface, the engine is still processing. When the dimensions confirm together, serious capital acts. 6 ways resonance, then fire. One of the biggest blind spots for retail investors is corporate governance. Retail buys a ticker and hopes CEO performs. They hope management is disciplined. They hope capital is allocated properly. They hope shareholder value is protected. Institutions do not only hope, they engage management. They push capital allocation. They push dividends, buybacks, discipline, and better corporate decisions. There is the Buffett philosophy. Never buy only a symbol, buy the business behind it. Own the business, not a ticker. This is why capital flow matters. Large capital does not simply accept the price. It shapes price discovery. It sets sentiment. It decides where liquidity sits. A governance shift can re-rate an entire market because governance changes how investors value the future of the business. Retail often waits for the breakout because the breakout is visible. But institutions position before the breakouts because they are reading the forces that can create it. Retail positions for the candle, capital positions for the end game. Now we move into other half. Peter Thiel opens 0 to 1 with a brutal truth. Competition is for losers. Most retail traders fight for every tick in a crowded red ocean. They watch the same candles, chase the same breakouts, react to the same headlines, and compete against algorithms faster than the eye. Institutions are not playing that game. They do not only ask what should we buy, they ask what price can we lock before the crowd arrives. That gap is the cost gap. Retail treats the markets like a battlefield. Every tick becomes a fight. Every candle becomes a decision. Every small movement feels like a pressure. But more crowded the field becomes, the harder it is to win. That is why institutions focus on something real and usually cannot see. Scale, relationships, access, and negotiated structure. They are not trying to be the fastest person in the same crowded room. They are walking into another door. Play from strength, not from crowds. How did Phil build PayPal? He did not fight the giant banks head on. They owned one overlooked niche. Payments for eBay sellers. Once PayPal became the preferred network, their network effects took over. Power compounded fast. That is a powerful market lesson. You do not win by fighting everyone in the most crowded place. You win by finding the angle where the crowd is not looking yet. In trading, the same principle applies. Do not fight where everyone is fighting. A monopoly does not start big. It starts by completely owning one small, specific market that everyone else ignores. At first, it does not look like dominance. It looks small, it looks boring, it looks too narrow for the crowd to respect. But that is exactly why the opportunity is still there. The crowd wants the obvious battlefields. Professional capital looks for the structure before it becomes obvious. Dominate a niche before you scale. Thiel approaches business like a chess player. He's not just reacting to the last move, but he's planning several moves ahead. That is what separates strategy from emotions. Retail often reacts to what just happened. The headline dropped, the candle moved, the chat group got loud. But serious players think before the moment arrives. They ask, where is the board going? Will liquidity move next? Where will the crowd be forced to react later? The winner is often one who set up the board before the game look decided. position early and win later. The PayPal founders went on to build one of the defining companies of our era. From Tesla and SpaceX to Palantir, they did not chase competition, they hunted monopolies and secrets. They built where others were not even looking. This is not only technology's lesson, this is also a market lesson. The best openings rarely starts where the crowd is already shouting. They begin where a small group sees a structural opening before the rest of market understands it. If everyone is already staring at the same place, the edge is already crowded. Look where the crowd is not. Now, apply this to trading. Retail platforms give you access to the public markets. That is useful, but it is still the red ocean where everyone chases the same visible price. Vanguard, BlackRock, and Millennium operate differently. They use scale and access to negotiate better entry costs instead of simply chasing the same public price. Same stock, but different start. That difference can change the entire outcome of the trade. Enter with advantage, not with the crowds. Phil's second core idea is secret. The world is full of hidden truth that the crowd cannot see. The data is there for everyone. The annual reports are there. The charts are there. The news is there, but access to data is not the same as the ability to see the truth inside the data. Retail often think the edge is having more information, but the real edge is seeing what other cannot. Sometimes the secret is not hidden because nobody can access the information. Sometimes it is hidden because most people do not know how to interpret what is already in front of them. The edge is seeing what others miss. So, what is the ultimate secret in the stock market? Retail assumes everyone competes on the same terms. They assume the price on the screen is the price everyone pays. That assumption is simply not true. Before the public market opens, institutions can reach negotiated transactions and block trades and entry costs retail never sees. That is where the real separation begins. Retail think the game is only about direction, up or down, buy or sell, green or red. But institution understands that the starting point matters. The secret is not a better indicator. The secret is access. This brings us to the ultimate paradigm shift. Retail obsesses over the timing gap. Everyone reads the same charts, studies the same candle, and asks the same question. Will it go up? But institutions focus on the cost gap. They focus on securing a structural advantage before the market even opens. Because if your entry cost is lower, you do not need to fight the same battle as everyone else. Retail competes on direction. Institutions compete on entry cost. Stop competing on direction. Compete on entry cost. Let us run the numbers. If you buy at 100 and sell at 110, you make 10. But an institution that locked a block at 90 already holds a 10 heads. Start before the bell. If that institution sells at the same time at 110, that is 20. Roughly 22.2%. Same stock, same chart, different steering line. There is why cost basis matters. There is why access matters. That is why execution matters. Lower entry, but bigger edge. Last session I used Rolex as an example. This time, let me use something of you may be more familiar with. Think of a newly launched condo. An ordinary buyer usually enters later, after the best units have already been taken, and pays the public launch price. But private clients with early access to get enter first, they can choose the better units and sometimes even structure better pricing before the public sees the full offering. The property may be the same, the location may be the same, the project may be the same, but the starting position is different. That is idea behind pre-market block trades. A pre-market block trade is similar to a VVIP preview. We have seen this before. In 2008, Berkshire negotiated Goldman Sachs warrants at 115 US dollars, while the public paid $123. $8 a share, worth billions. The principle is simple. Large capital negotiates terms that retail cannot access. This is the difference between public participation and negotiated access. Retail walks in the front door and takes the visible price, better entry, lower costs, and stronger position. In 2021, Wall Street shorted GameStop hard, treating retail as weak and scattered liquidity. Then retail gathered on Reddit and found one truth. United, they were a force. GameStop rocketed roughly at 1,700%, and the shorts were forced to cover. Now, before I continue, if you are a retail investor, type Retail United in the comments, and we're gonna check it. Mhm. Mhm. Okay, we go on. For that moment, retail did not just participate in the market. Retail United acted as one, took on Wall Street and won. This is exactly why Millennium exists. Retail alone is scattered. Retail alone is emotional. Retail alone becomes the liquidity. But when retail is organized, educated, and structured, the game changes. We bring members together and combine collective strength. The goal is to turn scattered retail traders into an institutional level force. By operating together, we negotiate block trades, capture institutional discounts, and pursue the same structural cost edge by design, not by luck. Together, we rewrite the rules. Tonight's ebook is 0 to 1 by Peter Thiel. Real progress means going from 0 to 1. It means creating what others have not created. It means seeing what others have not seen. And in these markets, it means understanding the structure most people never think to question. Do not let another week pass standing outside the conversation. React to the same public information and competing on the same terms as everyone else. Find the secret. Secure the cost gap. Tomorrow afternoon, Saturday, 29 August, 2:30 p.m. at a private location in Dempsey Hill, there is not a public seminar. This is a closed door round table for Phase 1 members, with seats strictly limited to maintain the quality of the room. The guest list closes tonight. If you are serious about upgrading your environment, WhatsApp Jesse now and secure your seat. Access determines the starting point. And the starting point can changes everything. Decision first. Cost second. Make your choice. I will see you on the inside.